Tesla, if you're analyzing cars, not by brand, although its brand certainly has done wonders in the last few years, but if you look at range and power, the combination of those, most other auto manufacturers, unless they want to lose money on the cars, most are not going to be able to keep up with or to reach Tesla's combination. So that's very important from a performance point of view and a range point of view. Branding is something different. These other auto manufacturers have brands and a lot of brand loyalty. But I think as consumers start to shift from gas-powered to electric and look at the specs of the different cars, they might still be persuaded by brand only, but they won't have as good an electric vehicle as Tesla will provide. And actually, we've been studying the CapEx schedules for traditional automakers versus Tesla. Tesla is now within the next year or so is going to spend more on electric vehicles, if it is not already, than either one of those companies. So here were the behemoths where, 5 years ago, when most people were saying, Tesla doesn't even have a shot to exist, it's going bankrupt. Now it is spewing out cash and spending as aggressively as it can to roll out new plans. So we think they'll announce another one before the end of the year. We're getting all kinds of signals that the economy is very weak. I know a lot of people are focusing on last employment gain in non-farm payrolls, but if you look at household employment, which is a much broader based survey of employment, that has been flat to down for the last 4 months. If you look at claims, we've never seen a faster increase off the bottom than we've just seen. We're up roughly 50% from the lows. Many people, I don't think, have taken a close look at that. And we're hearing one layoff after another. And we know the Challenger survey says that layoffs are up 55 to 60% year over year. And I think this is all related to inventories. We have a massive inventory glut. And so I think that the last few hires, I think companies were really happy to get them because labor was in short supply for so long. Now the CPI and in some measure the PPI, both of those are lagging indicators. The Fed is driving policy off of lagging indicators. If I look at Dr. Copper, the commodity with the PhD, it had been trading for a year in the $4 to $5 per pound range. It's now down to $3.50. It's had a decisive break. And if you look at how that's going to feed into the indexes, it'll feed in slowly to be sure. But just month over month, copper is down roughly 20%, and year over year, it's down roughly 20%. So that's the activity side of things. If you look at the real inflation gauge out there, it's gold. Gold prices peaked in August of 2020. And we've been in a trading range, to be sure. We're at the low end of that trading range now. Right. If the Fed continues to tighten, we believe the dollar will turn back up and these commodities will continue to fall. We believe we're in a recession. 2 consecutive quarters of real GDP declines is the beginning of that definition. 3 consecutive months of declines in leading indicators, which we have now, would suggest the same. Now, I think the differences are, we see an inverted yield curve, and that, of course, is also a warning sign. I think our point of view is that this is going to be a severe inventory recession, but we didn't have the systemic excesses like we did pre-08-09 in the mortgage market. So it's an inventory recession here. And while most economists are saying, the inverted yield curve points to a recession maybe next year, we believe we'll be coming out of it next year. Now, I think the big question is what's going on in China. I think some of the commodity price decline has to do with China unraveling in some sense from a cyclical point of view. I mean, they've got their foot on the brake in many ways. They're trying to let it off a little bit here and there. But I think that the real estate downturn in China is 30% of their economy, 75% of consumer savings. I think they're not going to be able to control it the way they thought they were. We are going to be 100% invested in innovation. That's who we are. This is what we're paid to do. This is what we say we are. And we think that innovation is going to be a critical allocation in the years ahead as the world moves rapidly. And it tends to innovation tends to gain traction during tough times. Innovation solves problems. We have so many problems right now. We've got the supply chain problems, which we're still hearing about. We've got energy and food prices up because of the war, really hurting consumer purchasing power. And so I think better, cheaper, faster, more productive, more efficient, more creative is going to win. That's what innovation is. So we think most asset allocators are short innovation. And I don't mean NASDAQ 100. We don't think that's truly disruptive innovation. We believe that ARK is more the old style NASDAQ than the NASDAQ is today, because that's all we focus on. What I've always said when people have asked us about our portfolios, I've always said they are intrinsically good for the environment, socially good, and we have a scoring system around governance. So we certainly are focused on doing the right thing, which is what I think ESG is all about. I think it got way out of hand, and there was a lot of slapping lipstick on a pig, and basically any portfolio being kind of promoted as ESG. So I think the misallocation of capital was quite extreme. And I do the whole index-based phenomenon, the idea that we should look to the past to manage assets for the future just doesn't make any sense to us. Very few companies are doing what we do right now. The kind of top-down research that we're doing, the 5-year investment time horizon, the kind of bottom-up research as well. And as you know, we're starting to put our models out there because we think there are so many inefficiencies in research and investing when it comes to innovation. So you've got on GitHub, any of you can go check it out. We've got Tesla, Zoom, and Roku now, with others to follow during the next few months.